It's Monday, February 23rd. Bitcoin is hovering around $68,000. Not crashing, not rallying, just sitting there. Fear and greed? Still in extreme fear. 14 on CoinMarketCap, single digits just weeks ago. We lost over $1 trillion in market cap from the highs. And yet, no collapse, no breakout, just a market that feels confused. The digital gold narrative is under pressure. Tariffs are back in the headlines. The Fed is still hawkish. ETF flows? Quiet. Dip buyers? Cautious. And somehow, everyone is still waiting for the bottom. This isn't euphoric. This isn't panic. This is something worse. This is exhaustion. So today, we're not just reading headlines. We're building the playbook for the week ahead. Tariffs, CPI, token unlocks, ETF flows, and whether extreme fear is about to flip or fracture. Welcome back to the SENB Daily Brief. Let's get rational.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, let's get into the numbers. As of this morning, February 23rd, Bitcoin is trading right around $68,000. We've been bouncing between roughly 66 and 70,000 over the past several sessions, but no decisive breakout in either direction. Ethereum is sitting near 1970, Solana hovering around $79, XRP around $1.36. Total crypto market cap, roughly $2.3 to $2.4 trillion. That's slightly green on the day, but still significantly down year to date. And here's the key structural number. Bitcoin dominance, holding near 58%. Capital is not rotating aggressively into alts. It's hiding in Bitcoin. And even there, it's cautious. Now let's talk sentiment. Fear and greed index currently around 14 on CoinMarketCap. Extreme fear territory. Just weeks ago, we were printing single digits. That's not panic selling anymore. That's emotional fatigue. Volume has cooled. Leverage has largely been flushed. ETF flows have been muted to negative. We are not in a euphoric blow-off. We are in a slow grind. So, what does this actually mean? Markets don't bottom when everyone is terrified. They bottom when everyone is tired. Right now, we're somewhere in between. We've had the deleveraging, we've had the headlines, we've had the $1 trillion drawdown narrative, but we haven't had a clear catalyst either way. And that brings us to the outlook. This week is not about crypto narratives. It's about macro. The move to 15% global tariffs is now the dominant macro overhang. Markets are pricing higher inflation risk, higher for longer rates, lower risk appetite. Crypto remains highly correlated to tech. If the Nasdaq sneezes, Bitcoin catches pneumonia. Watch for retaliation headlines. Watch for de-escalation rumors. Even minor trade headlines could trigger 5 to 10% intraday swings. Now, this is a heavy macro print week. Hot CPI, rate cut hopes die again. Risk assets sell. Cool CPI, relief rally potential. Right now, crypto is trading more like a leveraged Nasdaq ETF than a revolutionary monetary asset. Macro surprises matter more than on-chain fundamentals in this environment. Third, we have token unlocks and network volatility. SUI unlock, Humanity unlock, Grass unlock, multiple mid-cap events that could cause short-term liquidity stress. In a thin market, unlocks hit harder. 5 to 20% swings are not dramatic anymore, they're normal. Next, we have ETF flows. This is critical. We've seen multi-week outflows from spot BTC and Ethereum ETFs. If that reverses, even modest inflows, that's your first real bottoming signal. If outflows continue, expect grindy downside pressure. Institutions are the liquidity backstop right now. And finally, the regulatory and policy whispers, Clarity Act delays, stablecoin negotiations, White House crypto messaging. One positive regulatory headline could flip sentiment fast. But right now, tariffs are stealing oxygen. So, what's the real setup? We are in a macro-dominated market. No massive bullish catalyst is on the calendar. Extreme fear suggests bounce potential, but bounce potential is not the same as trend reversal. If we get cooler CPI, tariff de-escalation, ETF inflow shift, then we could see a sharp relief rally. If we get hot inflation, escalation rhetoric, continued outflows, then 65,000 gets tested again, possibly lower. This week will not be decided by memes. It will be decided by data. Stay objective, stay liquid, and do not confuse volatility with opportunity. All right, let's move into the first major story of the week, where we talk about Bitcoin's ongoing identity crisis. All the details when we come back.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
Welcome back, everyone. Now, let's talk about the elephant in the room. Bitcoin is having an identity crisis, and it's not subtle. Since the October 2025 highs, Bitcoin's market cap has shrunk by over $1 trillion. $1 trillion. That's not volatility. That's a narrative shift. And who's feeling it? Retail holders? Millions of long-term hodlers are now underwater again. Institutions, BlackRock, and Fidelity. Spot ETFs seeing multi-week outflows instead of inflows. Miners, profitability at 14-month lows. Hash rate holding, but margins tightening. And analysts, Bloomberg, CryptoQuant, and Glassnode, all using the same phrase, a $1 trillion identity crisis. That's not Twitter drama. That's institutional research desks. So, what actually happened? Bitcoin dropped below 60,000 earlier this month. That was February 3rd through 6th. Heavy liquidation. Asia leverage unwound. Binance and Coinbase saw aggressive volume spikes. Yes, we bounced back into the mid-60s, low 70s briefly. But it's been a weak bounce. No conviction. No surge in ETF inflows. No corporate treasury buying wave. No Michael Saylor moment. Just stabilization. And where did the pressure come from? Macro. Washington, D.C. tariffs. Wall Street tech earnings uncertainty. Federal Reserve hawkish tone. And AI spending doubts. Investors rotated into gold, into bonds, into cash. And here's the uncomfortable truth. Bitcoin did not behave like digital gold. It behaved like a high beta tech stock. When risk assets sold, Bitcoin sold harder. That's the identity problem. So why does this matter? Bitcoin's brand for years has been inflation hedge, safe haven, digital gold. But during a tariff escalation, during inflation uncertainty, during global macro stress, gold rallied. Bitcoin dropped over 40% from highs. That disconnect is what analysts are debating right now. Now, where could this go? Short term, if macro stays ugly, a retest of 58 to 62,000 is very possible. That zone has already been tested once. Markets like to revisit liquidity. Medium term, a real bottom likely forms when two things happen. ETF inflows return and realized losses slow down. Capitulation must transition into accumulation. We are not clearly there yet. Long term, if regulation stabilizes, if the Clarity Act progresses, if Bitcoin reclaims a clear role in global finance, then yes, the digital gold narrative can rebuild. And when it rebuilds, it can move violently to the upside. But narrative recovery takes time. Right now, Bitcoin isn't broken. It's being questioned. And markets hate uncertainty more than they hate bad news. We'll know the identity crisis is ending when capital stops leaving and starts choosing Bitcoin again. All right, when we come back, we'll move to the sentiment side of this because fear right now is historic. That's coming up next.
Some mornings start quiet. No rush, no noise. Just good people and the decision to roll forward.
Okay, we're back. Now, if Bitcoin is having an identity crisis, sentiment is having a breakdown. The Fear and Greed Index just printed the lowest reading in its entire history. 5. Not 50, 5. Even during the 2022 bear market bottom, it didn't get that low. Who's driving this? Alternative.me, the creators of the index. Social sentiment trackers like Lunar Crush and Santiment, and every trader staring at that gauge like it's a heart monitor. Retail panic is the dominant force here. Institutions, much quieter. In some cases, accumulating. But retail, exhausted, over-leveraged, emotionally tapped out. So, what happened? The index crashed to 5 on February 5th and 6th. That was during the sub-60,000 Bitcoin wick. Liquidations cascaded. Realized losses spiked. Over $2.3 trillion in total market cap contraction. More than 22% down year to date. And the emotional damage? Severe. FOMO is gone. The number go up crowd is gone. What's left? Blood in the streets memes, contrarian, buy fear threads, and people who bought the top panic selling the bottom. So where is all this fear coming from? Globally, the U.S. retail market was hit hardest. Asian leverage traders amplified the downside. European funds rotating defensively. But it's all feeding the same sentiment loop. Sell, see red, sell more. That's how extreme fear compounds. And here's the uncomfortable truth. Markets rarely bottom in optimism, they bottom in despair. In 2018, in 2022, extreme fear marked major cycle lows. But, and this is important, extreme fear alone does not create a rally. It creates the conditions for one. Macro still matters. Tariffs still matter. CPI still matters. If macro pressure continues, fear can stay extreme longer than people expect. Looking into my crystal ball, for short term, as long as the index stays in single digits, volatility remains elevated. Relief bounces will be sharp, but fragile. Medium term, a sustained move back above 20, 25, that's when you start talking about the worst being over. And what should you watch for? Green daily candles with conviction, ETF inflows flipping positive, realized losses slowing. That's how sentiment flips. Not with hope, with capital. Right now, the market isn't greedy, it isn't confident, it's scared, historically scared. And historically, that's when the smart money starts paying attention. After the break, we talk macro pressure because tariffs just escalated again. That's coming up next.
She redefined what it meant to race without limits. She proved that silence could be louder than words. Fearless, fast, focused. A reminder that champions are built on grit. That same intensity now fuels her signature blend. Roosted and roasted. Bold Italian roast crafted with the spirit of champions. Ashley's Roosted and Roasted, only at wholeshotcoffee.com.
All right, if the last two stories weren't enough, we now have tariff drama back on the front burner. And yes, it's hitting risk assets. President Trump announced an increase in global tariffs from 10% to 15%. Despite the Supreme Court recently striking down parts of the earlier IEEPA emergency actions, markets heard one thing: escalation. So, who's all involved? The White House, the Supreme Court, EU leaders preparing retaliation, South Korea trade negotiations, and global markets reacting in real time. This wasn't a slow burn headline. It hit February 18th and 19th, and crypto responded immediately. What was the reaction? Bitcoin dipped roughly 0.5% to 1% on the announcement. Ethereum slid around 0.45%. Equities weakened. The dollar strengthened. Gold caught a bid. Classic risk-off rotation. Not catastrophic, but decisive. And here's what matters. Crypto didn't decouple. It moved with tech again. So, why is this bigger than one headline? Tariffs are not just trade policy. They're inflation policy. They're liquidity policy. They influence Fed expectations, and they amplify global uncertainty. The market fears escalation. Europe, Greenland pressure, South Korea imports, retaliation risk. Every headline becomes a volatility trigger, and until that noise clears, risk assets remain fragile. Here's the uncomfortable piece. If Bitcoin were behaving like digital gold, it would have rallied on geopolitical tension. Instead, it traded like a high beta tech stock. That reinforces the identity crisis narrative from earlier. Macro stress is still dictating price, not on-chain metrics, not long-term adoption curves, macro. So where is this all going? Short term, if tariffs stick or escalate further, expect continued grindy downside pressure. Expect correlation with equities to remain tight. Medium term, relief rally potential exists. There are rumors of G7-level talks. Any signal of negotiation progress could spark a sharp bounce, because positioning right now is defensive. And when positioning is defensive, even small positive headlines can move markets quickly. Until trade tensions cool, crypto remains in the crossfire. This is not a crypto-specific sell-off. It's a liquidity environment shift, and liquidity decides everything. After the break, we shift from macro pressure to institutional perspective, because one major CIO just made a very bold call. Getting into it when we come back.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
And we're back. Now, even in the middle of a bloodbath, some big voices are naming their conviction plays. Matt Hogan, Chief Investment Officer at Bitwise, one of the more respected institutional voices in crypto, and he just made something very clear. In this bear market, there are only 4 assets he believes are worth owning long-term: Bitcoin, Ethereum, Solana, Chainlink. That's it. Now, Hogan isn't a Twitter influencer. He's managing institutional capital, New York-based ETF-level capital. When he speaks, allocators listen. And these comments dropped February 17th through 19th, right in the middle of the macro storm. So, what is he saying? This is not a buy everything market. This is not a rotate into memes cycle. In a true bear market, only infrastructure survives. Bitcoin, digital gold. Ethereum, global settlement layer. Solana, high-speed execution engine. Chainlink, Oracle backbone connecting smart contracts to real-world data. Everything else? Noise. Well, is he right? In every cycle, speculation explodes first. Then it gets wiped out. What remains? Foundational infrastructure, projects with real utility, strong developer ecosystems, clear roadmaps, institutional traction. Hogan is essentially saying, strip the market down to its structural components. These 4 are the core. And how is the market reacting? The comments went viral on X. Half the crowd called it a buy list for the dip. The other half said it was institutional hopium. But here's what's interesting. Even in extreme fear, people are looking for anchors, for conviction, for clarity. And this list provided that. So, what's next? Looking short term, these four are likely to outperform on relief rallies because capital concentrates in quality during uncertainty. Medium term, if we see ETF inflows return, if macro stabilizes, these assets become the core portfolio for the next expansion phase. Long term, if Bitcoin eventually reaches the 500,000 thesis Hogan has floated in broader commentary, then this bear market becomes a footnote. But that's a multi-year arc, not a weekly candle. Bear markets remove noise. They expose what matters, and institutional voices are already narrowing the field. 4 names: infrastructure, survivors. All right, after the break, we finish with a very different tone, because one project is quietly becoming one of the most talked about value plays publicly while everyone else is panicking. I'll spill all the tea on what that project is after this.
Monday morning starts here, coffee in hand, ready for the grind. Leaving the bike behind, chasing the week ahead. Fueled by the passion to ride and the coffee that gets us there. Whole Shot Coffee. Fuel your life.
All right, I'm sure you're all wondering, what project could be so riveting I need to talk about it? Well, are you ready for it? Are you sure? Okay, it's Cardano. Yes, you heard me correctly. ADA is quietly becoming one of the most talked about value plays in this market. Not because it's ripping, not because it's flashy, but because it's down, way down. Cardano is trading around 28 cents, more than 90% off its all-time high. And that's exactly why bargain hunters are circling. So, who's pushing this narrative? Motley Fool analysts, longtime Cardano community leaders, and retail investors on ET who see blood in the streets and opportunity. Between February 15th and 21st, the 257% to $1 thesis went viral. The math is simple. From 28 cents back to $1, that's roughly a 2.5 to 3 times move. So, why Cardano? In a market that punished hype coins, ADA represents something different. Slow, research-driven, peer-reviewed development, focus on scalability upgrades, real-world pilots in education and government, particularly across parts of Africa and Europe. It's not the loudest chain, it's not the fastest marketing machine, but it's methodical. And in a bear market, methodical starts to look attractive. Bear markets change psychology. Speculators disappear. Survivors look for durability. Cardano is being framed right now as the reliable old truck, not the flashy new rig, not the meme rally machine, but the one that keeps running when the storm hits. So, where does it go from here? Well, short term, if the broader market remains weak, ADA could absolutely test lower first. Value doesn't stop volatility. Medium term, if upgrades land, if real adoption expands, if macro stabilizes, then $1 is not unrealistic. It's simply a reclaim of psychological territory. Long term, if the network continues delivering on roadmap and developer growth, Cardano could quietly outperform many of the projects that grabbed headlines during the bull. But that's execution dependent, not narrative dependent. In bull markets, speculation wins. In bear markets, discipline gets rewarded. And right now, ADA is being reevaluated through a discipline lens. All right, that wraps our major stories for today. After the break, we open the mailbag, and today, we're having some fun with it. Stay with us.
You're listening to the SENB Daily Brief, powered by Whole Shot Coffee.
All right, it's mailbag time. And judging by the tone of your messages this week, you all need a hug. And possibly a spreadsheet. Let's begin. This one comes from @Sats&Regrets. Sen, be honest. Are we cooked? Define cooked. Medium rare? Well done. Charcoal briquette? No, we are not cooked. We are uncomfortable. There's a difference. Cooked means structural failure. Uncomfortable means volatility plus macro pressure. Bitcoin at $68,000 is not cooked. It's bruised. Okay, this next one comes from @GoldBugGary. Should I sell everything and buy gold? If you wanted gold, you probably should have bought it before tariffs hit. But honestly, diversification isn't betrayal, but panic rotation at the bottom, that's how retail builds generational regret. Liquidity rotated into gold. Liquidity left crypto. If liquidity returns, those flows reverse. Timing matters more than emotion. Next, we have @BagHolder92K, and they write, I bought at $92,000. Please tell me I'm not an idiot. You are not an idiot. You are human. Bull markets convince people that risk has disappeared. It never does. The lesson isn't shame, it's sizing. Next cycle, smaller entries, layered buys, and maybe don't go all in after 3 green candles and a TikTok influencer yelling, inevitable. This one comes from @BottomSignalBro. Is this the bottom? If I knew that with certainty, I would not be reading your comment. I would be on a yacht. Look, bottoms are a process, not a candle. Extreme fear is a condition, not confirmation. Watch ETF flows. Watch realized losses slow. Watch higher lows form. That's how bottoms develop. Quietly. And finally, this one comes from @ADA or bust. Should I just go all in on ADA because it's down 90%? Haha, yes. The it can't go lower strategy. A classic. Look, value hunting is fine. Blind conviction is not. Cardano might rebound. It might dip first. If your strategy is, I feel pain and this looks cheap, that's not analysis. That's coping. Okay, look, I know bear markets feel personal. They're not. Markets don't target you. They punish leverage. They punish impatience. They reward discipline. Right now, the market is testing discipline, not destiny. You are not late. You are not doomed. You are in a cycle. Act like it. All right, let's close this out properly. My final thoughts coming up next, right after this.
Our beans are washed in ancient waters, filtered through coal seams deep beneath the Utah mountains. Okay, not really. We totally made that up. But it does sound badass, doesn't it? Here's the truth. Premium Guatemalan beans, aged for 30 days in real whiskey barrels, then carefully roasted smooth in the golden light of California, inspired by the legendary Drunkard's Wash Desert Race in Price, Utah. Bold, smooth, with a subtle touch of whiskey and oak. Drunkard's Wash. Whiskey barrel aged, bold and unmistakable. From Whole Shot Coffee Company. Fuel your life.
Here's something nobody tells you about markets. The hard part isn't the crash, it's the waiting. Bull markets are loud. Bear markets are quiet. Bull markets are screenshots and victory laps. Bear markets are spreadsheets and self-doubt. And right now, we're in the quiet part. Bitcoin isn't exploding. It isn't collapsing. It's grinding. Fear is elevated. Liquidity is cautious. Macro is noisy. And everyone is looking for a signal. But this is the part nobody posts about on Instagram. The discipline phase. The uncomfortable phase. The part where you either build resilience or build regret. Markets move in cycles. Hype, euphoria, correction, capitulation, exhaustion, recovery, expansion. We are somewhere between capitulation and exhaustion. And that's not a bad place to be. It's just not exciting. If you're still here, if you're still watching, if you're still learning, you're ahead of most people already, because most people only show up when things are easy. You're here when it's hard, and that matters. This week will be decided by data, tariffs, CPI, ETF flows, liquidity shifts, not emotions, not memes, not panic. Stay objective, stay disciplined, stay solvent. And remember, their markets don't end with fireworks. They end with boredom, and then suddenly, momentum. We'll be here either way, through the grind, through the noise, through the rebuild, because cycles change and capital flows back to conviction. Well, that's it for today. If you like what we do, give us a follow and tell your friends and family about us, and I'll see you on the next one. The SENB Daily Brief is a production of SENB Media in collaboration with Whole Shot Coffee, coffee that fuels champions. Written and hosted by yours truly, SENB Hero. Production editing and scheduling handled by Maya Valencia, who somehow keeps me on time, caffeinated, and occasionally polite. Original theme music composed and produced by Paul Hahn, the community legend whose beats hit harder than a Fed rate hike. Research support provided by the SENB community. Proof that sarcasm and spreadsheets can coexist. For more shows, merch, and on-chain chaos, visit SENBHeroMedia.com. Thanks for tuning in. Stay caffeinated. And remember, if it's not in the brief, it probably wasn't bullish anyway.
Set my wallet free.